Joining us now is Mark Grant, Managing Director of Southwest Securities. Mark, always good to see you. I always enjoy reading through your emails throughout the day. You're watching the situation so closely. What do you make of the latest headlines?
Well, the truth is, and where the equity markets, I think, have made a tremendous error, and Finland today said it this morning, the head of the Finance Committee of the Parliament of Finland, he said any change at all to the stabilization fund, to the EFSF, they call it, has to go back to all the parliaments to be approved, and he had serious doubts whether Finland would approve it. So all the optimism and all the froth about perhaps that they're going to enlarge the size of the fund, I think is nothing but a pipe dream that the equity markets are having. Clearly, the debt markets get the joke. I mean, you see the Italian 10-year is back at 6%, which was the danger zone last time, and this is after the European Central Bank has been in buying bonds on a consistent basis. So there's a large divergence between the bond markets and the equity markets now.
Now, the interesting thing is, because I'm looking right now at spreads in the sovereign market, Italy, Spain, Portugal both saw their spreads widen out today, yet Greece's 10-year debt, at least, came in about 38 basis points. I know you're worried about Greece. You're not even sure if they're going to make it to the weekend. What is the market telling us, and do you disagree?
Well, I mean, the yield on the Greek bonds are so high, whatever you're seeing is just small movements by somebody squaring up some positions. It really doesn't have so much meaning. The meaning, as you just identified, is in Portugal, Spain, and Italy, all which have seen their yields gap out significantly. The other big issue here that I did write about in my commentary today was France. France, I think, is right on the verge of being downgraded, and I think that's one of the huge issues that's taking place between Germany and France at this time, and why they can't come to any kind of agreement.
What is France getting downgraded, though? How is that holding up the process?
Well, if France gets downgraded, it means that one of the two big pillars that support the Eurozone is no longer AAA rated, which means probably two things. One, obviously France will have to pay higher costs to fund themselves, and two, that the ECB itself and all the Eurozone entities may get downgraded and also have to pay higher amounts of money. And I think, frankly, the situation is so serious that I think that Germany eventually is going to get downgraded, because the Eurozone has a GDP that's about 34% of their banks. In other words, their banks are 3 times larger than the GDP of all the countries in the Eurozone. So if they're having to bail out the banks by using the sovereign nations, it is going to put a tremendous strain on the sovereigns to fund.
So what do these countries need to do? I mean, that's the first time I've heard that Germany might be at risk of losing their credit rating or their AAA status. What do they need to do in order to stop that at this point? Do they need to just focus on Greece? The government there needs to push through those austerity measures?
The problem is, in my opinion, they can't stop it. They're up against the wall. They've played all the games they can play. They've shifted money and assets out of the banks into the ECB. They've given us stress tests that were not the truth, to be honest with you. They just were not true. And they've done everything that they can, and now they're up against the wall because they have to recapitalize the banks. That number probably is around $500 billion if you were going to do it adequately. They're talking about much smaller numbers. They have no room left to go. Either they have to federalize, which would mean Germany gets downgraded and everybody goes to an average in Europe. All the countries would just be the same in terms of not only debt but standard of living, and I just don't see that happening in Germany, Finland, the Netherlands, Austria. Or you have to go the other way, which is you're seeing a rise in nationalism and people in different countries saying, we're just not going to spend our hard-earned money so that people can sit in Greece and drink ouzo on the beach.
Mark, where are we going to be a month from now? And what is Europe going to look like a month from now? Are you and I going to be having the same exact conversation?
Well, I think the conversation will be even more intense. If they don't recapitalize the banks and the sovereigns have to do it, you're going to see tremendous amounts of downgrades all across Europe. You're going to see Belgium, France, all kinds of countries being downgraded. But I really think what's going to happen before that is that Finland and some of the other countries who are the stronger countries are going to say, we're not going to increase the size of the stabilization fund. That's it. We're going to quit funding. This is just getting ridiculous.
And what happened? They drop out of the EU?
Well, they might leave the EU. The other two parts of the table, there's the funding countries, the funded countries, or the periphery countries. The two other parts of this are the citizens who are getting very angry. You see it in Britain, you've seen it in Germany, you've seen it in Finland, about using their money for all this nonsense. And the fourth leg of the table are investors who are just not funding. I mean, you haven't seen a bank issue being funded out of Europe, a new issue out of Europe since June. Investors just don't want to put their money. They just don't see the sense of it. There's just too much risk.
Mark, where do you think they should focus right now? Should it be on each individual country focusing on a plan to recapitalize their own country's banks? Should they be focusing on Greece? Should they be focusing on the EFSF?
Well, the answer to that, Julie, is yes on all of them. I mean, Greece is a real problem because not only do they have their sovereign debt, and a lot of people talk about Greece, well, it's this very small country, doesn't make any difference. That's not the issue. The issue is that Greece has altogether their municipal debt, their sovereign debt, their bank debt. They have $90 billion in derivatives, and the total amount is someplace around $1.1 trillion. And that's what people should focus on, not that Greece is a very small little country. So you have to deal with all those issues and the derivative issues, and then the CDS issues that could come out of this if it's perceived to be a forced default, and you could have just massive amount of problems all across the financial sector, including the United States. Then you have the issue of the stabilization fund. The size it is currently is nowhere close to dealing with the issues of recapitalization of the banks or of Italy or of Spain, as they have more difficulties. And it looks like Italy is going to report out some very bad numbers. And then you have the question, as I said, of the banks. How do you recapitalize them? The private sector is not going to do it. If the sovereigns do it, then you've got downgrades all across the board. And that's why I said Europe is up against the wall.
All right, it seems like there's too many problems perhaps for them to sort through at the moment, but let's go back to Greece, since that was the first thing you talked about there. Greece, right. At this point, the last we heard was that negotiators for the bondholders didn't want to take more than a 21% haircut. Have you gotten any updates as to where they may stand in those negotiations at this point?
I think they're in deadlock. They agreed to the 21%, and I think that's all the bondholders are going to do. And of course, Germany wants to force more on them. But if you force it on them, then you have a credit event, which puts the CDS markets and the derivatives into play, and nobody knows what that would look like. And in the derivative case, as well as the CDS case, you don't even know who the other side is that owns the credits. So it could get very messy, and I know that Europe is quite worried about this.
All right, well, Mark, well, it just so happens we have the CEO of ISDA coming on later in this show. That's the International Swaps and Derivatives Association, to actually clarify that topic, what exactly happens to all those CDS holders. But, Mark, always enjoy having you here on Street Smart. Thanks so much for breaking it down for us. I wish we had more time to go through the rest of that long list you went through. Thanks so much. Mark Grant of Southwest Securities.
Thank you, Julie.
Talking to you soon.